Hi everyone, back again with chapter 10. So now we're finished with the balance sheet. This is stockholders' equity, last section on the balance sheet. The next two chapters are fairly simple. We have one thing in chapter 11 and just a couple of things in chapter 12. So you're on the downhill slide, keep it going. So for chapter 10, stockholders' equity. Remember the accounting equation, assets equal liabilities plus stockholders' equity. So what we're talking about here are three things now. So we're just focusing on stockholders' equity. We have something called paid-in capital. That's the amount the stockholders have invested in the company. And then we have retained earnings. You know what that is. We've gone over and over and over that. And then we'll talk about treasury stock. Treasury stock is the company's own stock that's already been issued that it repurchased. What you need to understand is once stock is issued, it is never unissued. It then becomes treasury stock if it's purchased back. So on an organization chart, the regular organization chart usually have a board of directors or maybe a CEO, but ultimately stockholders should be at the top of it because the stockholders control the company with their vote. Stockholders have rights. They have the right to vote on all corporate matters, including the election of the corporate directors. They have a right to receive dividends. That doesn't mean the company has to pay them. It just means they have the right to receive them if the company pays them. They have a right to share in the distribution of assets. Let me just move this a little bit. If the company is dissolved, all the assets take the assets and pay the liabilities, and what's left belongs to the shareholders. It's distributed to the shareholders in their percentage of ownership. Advantages and disadvantages of a corporation. So advantages, limited liability. You can only lose what you invested. So if somebody sues the corporation, they cannot sue you. Easier to raise capital and transfer ownership because you do that just by issuing stock or selling stock or transferring the stock that you already own. Disadvantages, corporate earnings are taxed twice, once at the corporate level and once at the individual stockholder level. And I believe we talked about that earlier in the semester. And there's more paperwork for a corporation because they have to follow some additional federal and state guidelines. They also have to file their own tax return. They have to file all kinds of different things that an individual does not have to do. So when a corporation sets up, they determine the type of stock they have, um, and they determine how many shares are authorized to be issued. So that's how many that can be sold. So that's set in the corporate charter and it's done. It doesn't change after that. If you say I'm going to authorize 10,000 shares in your corporate charter, then that's all you can have. You can't create more. Well, you could create more, but that's a topic for a different class. Issued are the shares that were actually sold. And outstanding are the shares that were issued or sold and they're out there still held by investors. So, and we're going to talk about these things over here in a bit. Treasury stock are the shares issued and repurchased by the company. So here's the thing is once shares are issued, they stay issued. If you say you've issued 10,000 shares, that doesn't ever change. It doesn't matter whether you repurchase them or not. They're still issued. The only way to repurchase them is to go out on the open market and purchase them from another person. So issued would include outstanding shares, the ones that are out there and held by investors, plus the treasury shares. Authorized encompasses everything. So here's just another way to look at that. Outstanding stock and treasury stock are issued. Everything else is unissued, but the whole is authorized. Par value. That's the legal capital per share of stock that's assigned when the corporation is first established. That doesn't change. When you set up your corporate charter, you say 10,000 shares of $1 par value common stock. Has no relationship to the market value. So don't confuse the par value with market value. And I put something in here for you to read. This is not from the textbook because they would never say this, but it's from CapGenius, and you can click here and read the whole article. But basically what they're saying is par value is an archaic concept. The only thing that we really use par value for is to determine how much you have to pay for your founder's stock. So let's say you set up a corporation and you authorize 10,000 shares, but you want to be the sole owner. So you want all of those shares. Well, you have to buy them. But you have to buy them, if there's a par value, you have to buy them at par value, which is why you see par value numbers so low. $1, a penny, 5 cents, 10 cents. So that's what the value of the shares, minimum value, legal value. Now, there's different kinds of stock. There's common stock and preferred stock. In the past, we've just had common stock. Preferred stock can be convertible. The shares can be exchanged for common stock. They can be redeemable. They can be returned to the corporation at a fixed price. They can be cumulative, meaning they receive priority for dividends. If you skip a year in dividends and they're cumulative, the company has to go back and pay you dividends for the year that was skipped before they can give any to common shareholders. And the way that works, if it's cumulative, and I'm not going to go through this because we're going to do an example of this, but you can read through this if you want. Essentially, if it's cumulative, you have to go back and pay in arrears, and if it's not, you don't. But in any case, preferred shareholders get paid first before common stockholders get anything. Now, the stockholders' equity section of the balance sheet is going to start looking a little bit different. Now we've got two different types of stock, preferred and common, with a description: $30 par value, 100,000 shares authorized, 1,000 shares issued and outstanding. Common stock, 1 cent par value, 1,000,000 shares authorized, 1,000 shares issued and outstanding. And then additional paid in capital. That's everything that was paid in over and above the par value. And we'll do some examples of that. And then we have retained earnings for a total stockholders' equity. So we've expanded on this a bit. Now let's talk about treasury stock. Why would a company go out on the market and buy their own stock back? Well, nobody really knows who's purchasing the stock, but sometimes purchasing stock increases the price of the stock. So they may do it to boost underpriced stock. They may want to distribute surplus cash and they don't want to pay dividends. So they purchase back their stock. They may want to boost their earnings per share because earnings per share is calculated on how many shares are outstanding. You only pay dividends on shares outstanding. You don't pay dividends on treasury stock because you have that stock. You don't pay dividends to yourself. And sometimes there's an ESOP plan, an employee stock ownership plan. If they want the employees to own stock and they don't have any available, they'll have to go buy it back to issue it to employees. Let's talk about what treasury stock actually does. Now, the treasury stock account is a contra equity account. So in other words, it carries a credit or a debit balance instead of a credit balance. So here we have, before a treasury stock purchase, the number of, or the shares issued and outstanding, the additional paid in capital, the retained earnings, total stockholders' equity of $100,000. Now the company went out and repurchased some of this stock up here. Notice none of these numbers up here changed. Retained earnings didn't change. The only thing that changed is we have a negative $3,000 because that's what they paid for those 100 shares that they purchased back. That makes our stockholders' equity less, $97,000. But it doesn't change how many shares were issued. It only changes how many shares are outstanding. Then they can resell the treasury stock. So here's before the resale. And so they resold some of this stock, but they sold it for more than they bought it for. The treasury stock account, they sold it all. Excuse me. So the treasury stock account went down to zero. Whatever they sold it for over and above what they put it in the treasury for gets posted to additional paid-in capital. It still does not change preferred and common. We'll do some examples of that. And you know that retained earnings are all the earnings of a corporation since they began operations, plus net income minus dividends. That's what retained earnings is. It has a normal credit balance. Sometimes, however, it can have a negative balance. The company has a deficit. They had a loss that year. Note that you can't pay dividends out of a loss. So year one, they had a loss, so they had a balance of retained earnings of a negative 1,000. But year two, they made 3,000. They still didn't pay any dividends, so their balance is 2,000. Year three, they made 4,000 and paid 1,000 in dividends, so now their balance is 5,000, and so on and so forth. But it can have a negative balance. In other words, a debit balance. That's net loss. They didn't make enough money, so they have a negative retained earnings. Dividends cannot be paid out of negative retained earnings. Cash dividends. That's the distributions to the stockholders. So not all companies pay dividends. Some reinvest their money rather than distribute it to the shareholders. There are three things you need to know about dividends. There are three dates. A declaration date. So you have to determine the date on which the board of directors declares the cash dividend. Then you'll record it. You'll debit dividends and credit dividends payable. They declared a cash dividend on the declaration date to owners on the record date. So there has to be a record date, because if stock is traded on the open market, you have to pick a day and go, whoever owns it on this day will get dividends. You don't make a journal entry on the record date. And then the payment date is the actual cash distribution. At that point, you debit dividends payable and credit dividends. So March 15th, they declared 25-cent per share dividend on 2,000 outstanding shares, debit dividends, credit dividends payable. We don't do anything on the date of record. So the dividend, the date they pay it, is when you will record the cash, debit dividends payable and credit cash. Oops. So now back to the stockholders' equity section. This is what it looks like. We now have details on the preferred and common stock. We have an account called additional paid-in capital. We have retained earnings, and we could have treasury stock. We need to convert all of that on the statement of stockholders' equity. Remember, do this by columns, not by rows. What happened to preferred stock during the year? What happened to common stock during the year? What happened to additional paid-in capital, retained earnings, and treasury stock? And note that this last column is simply a total of the rows all the way across. We're going to do some examples. They're all in this Excel template that I have. Let me pull that over. I will post this for you blank and with solutions. So brief exercise 10.4, Gothic. It's new chain of clothing stores. That tells us it's the first year. They issue 1,000 shares of $1 par value common stock at $30 a share. That means they got $30 a share for 1,000 shares. So they got cash of $30,000, which is $1 times, which is $30. Jeez, $30 times 1,000 shares. So they got $30,000. We're going to post to the common stock account only par value. Again, only par value goes in the common stock or the preferred stock account. So 1,000 shares, and it's $1 par value times 1. That's the total that goes in there. The additional goes to an account called additional paid in capital. Sorry. That would be 30,000 minus 1,000, or 1,000 times $29, right? So again, only par value goes in the stock account, whether it's common stock or preferred stock. The rest of the money you got goes into something called additional paid in capital. All right. How would the entry differ if they had no par value stock? Because you can have no par value stock. And just to make it totally complicated, you could have no par value stock with a stated value. In that case, you would treat it just like par value. But if it has no par on it, you just ignore everything. You just put cash and common stock. And both of them would be 30,000. Which is really what we've been doing. Okay? E1011. American Eagle declares a quarterly cash dividend of 0.125 cents per share payable on April 13th to all stockholders of record on March 30th. On March 15th, when they declare the dividend, it becomes a legal obligation. We're going to debit dividends and credit dividends payable. We're not paying it yet, but we are legally obligated at this point to pay it. So they have 210 million shares. Okay, let's see if I can get this number right. So 210,000,000 times 0.125. That's $26,250,000. Okay? On March 30th, that's the record date. There's no entry required. Because what would you record? There's nothing to record. April 13th, payment date, dividends payable, and cash. Increase or decrease dividends payable by the amount we posted to it, and increase cash by the same, or decrease cash by the same amount. E107. So this company has two classes of stock authorized. 8% $10 par preferred and 1% par value common. And we're asked to record these transactions. January 2nd, issued 100,000 shares of common stock for $35 per share. So we're getting cash. We're getting 100,000 times 35. So we're getting 3.5 million. Common stock, because that's what we're issuing, is the $100,000 or 100,000 shares times the par value for common stock, which is $1. The difference goes to additional paid in capital, and I'm going to abbreviate that. So 3.5 million minus 100,000 leaves us 3,400,000 in additional paid in capital. On February 6th, they issued 3,000 shares of 8% preferred stock for $11 per share. They got cash. Oops. They got cash. They got 3,000 times $11, or $33,000. How much goes into the preferred stock account? Just the par value. So that would be 3,000 shares times the $10 par value for preferred stock. The difference goes to additional paid-in capital. So 33,000 minus the 30,000 gives us 3,000 to additional paid-in capital. September 10th, they purchase 11,000 shares of their own common stock for $40 a share. That means that's actually treasury stock. And since treasury stock is a contra equity, you debit it to increase it. It's pretty simple. It goes in at cost, whatever you paid for it. So 11,000 shares times $40 per share. 440,000, and then you paid cash for it. So 440,000. December 15th, they resell 5,500 shares of the treasury stock at $45 a share. So if they resold it, they got cash, right? They got cash of 5,500 times 40 or times 45, right? Isn't that what they, yeah, right here, 45. How much comes out of the treasury stock account? You can only take out the amount per share that you paid when you put it in. So you paid $40, you're going to take it out at $40 a share. So that's wait a minute. Resell 5,500 shares. So 5,500 times $40 is 220,000. The difference goes to additional paid-in capital. So I received 247,500. 220,000 of that went into the treasury or came out of the treasury stock account. And that leaves me 27,500 to additional paid-in capital. The thing you want to remember here is you put the cost of the treasury stock in here, but you need to know when you purchased it how much you paid per share, because then you can only take it out at that amount per share, not the total amount, but the amount per share. Now, we're asked to look back at that information and prepare the statement of stockholders' equity section. So preferred stock, how much do we have in preferred stock? Well, if we look back over here, we posted 30,000 to preferred stock. How much to common stock? Look back here at our journal entries, 100,000 to common stock. Additional paid-in capital, we have to go back here and we need to add it all up. So what I'm going to do here is I'm just going to type equal. I'm going to go back here and I'm going to say additional paid-in capital of 3,400,000 plus 3,000 plus the treasury stock amount of 27,500. And then I'm just going to hit enter, and my total amount is here for additional paid-in capital. Total paid-in capital is the sum of all three of those things. Retained earnings. Well, we know retained earnings is beginning retained earnings plus net income minus dividends. So did they have anything beginning? Is this their first year of operations? Yes. So they did not have a beginning balance. So we don't need to take that into account for retained earnings. What we're saying here is 160,000, right? We paid dividends at the end of the year of 94,500 on common and 2,400 on preferred. So we want to subtract the dividends. 94,500 minus 2,400 gives us 63,100. How much is in treasury stock? Well, we need to go back here. We started out with 4,400 in there, or 440,000, and then we took 220,000 out, so I'm going to subtract that. I'm going to end up with 220,000. Oops. And this needs to be a negative number. Well, we'll just do it this way. Of 220,000 because treasury stock is a contra account. So total stockholders' equity is then total paid in capital plus retained earnings plus the negative treasury stock, or 3,403,600. Okay, and I'm not going to do this last one because I think it's a bit much. I will delete it before I send this out to you. That's it for chapter 10. Hopefully all is well in your world, and I will see you Tuesday for group work. Thanks.